And he is here now with the Market Navigator. And I'm not wearing jeans today.
No, you're not wearing jeans. But, I want to kind of dovetail off this conversation because you'd think with a drop in interest rates like the way we've been seeing, that technology stocks would be higher, right? But that's not the case. Apple's a big part of the story. But bank stocks are a big part of the story. They're getting a big boost this week. Some of America's biggest lenders and investment banks are kicking off earnings season with a bang. Better than expected results, but the gains in the bank stocks, not just limited to the stocks themselves. Bond investors could reap some big gains via the banks as well. So here to break it all down for us is Noah Wise, the senior portfolio manager over at Allspring Global Investments. Noah, the big bank story is huge because it is the catalyst for this part of the seasonal calendar, right? That's earnings season. Everything is getting going. But you're focused on the banks, not just because of their financial results, but what it could mean for bond investors. Explain.
Absolutely. Thank you for having me, Dom. This is an interesting time. We've got a big period of regime shift, we think. We think not only politically, economically, but also in the markets. And I think that the banks do play a big part of this. You're certainly seeing big moves in the yield markets as well.
All right. So if the yield markets are moving to the upside for price and the downside for yield, that could be good. It could be speaking some kind of a verdict about the U.S. fiscal outlook and everything else. But how exactly will that affect bond investors, and specifically which kind of bond investors and which types of industry would benefit more?
Yeah, absolutely. So the first thing I think it is worth highlighting the banks. Obviously, an incredibly good set of results that we've seen over the last couple of days from the big banks that you have focused on, rightly so. But it is not just an equity story. We do think that there is opportunities in the banking credit sector as well, where we do have overweight positions in our plus strategies. They provide incremental spread versus the industrial space, higher quality, but also fundamentally less risk. Risk specifically around the M&A environment. It comes back to this regime change. We do expect an increase in deals. That may mean more leverage for industrial companies, but it means more revenues for banking companies. And so we see a good relative value backdrop for banks. The yield side of the story is a little bit more challenging, though. We are coming from a period in 2024 where the markets were heavily data dependent. Now we're in an environment where the markets are policy dependent. And unfortunately, the timing associated with that policy is a little bit more challenging. We've seen some good data here over the last couple of days. It's provided a little bit of a bid to the fixed income markets. But we think when you take a zoom out, the shorter term challenges ahead of us around immigration policy and trade policy, those are the types of policies that are going to be implemented sooner. I think those are more of a challenge for the fixed income markets. As we get to the back half of the year, some of the more positives may be able to re-exert themselves.
All right.